While Bitcoin ETFs were bleeding over $1 billion in December 2025, something strange was happening with XRP. Institutional investors poured $1.3 billion into XRP ETFs in just 50 days. Not a single day of outflows for 35 straight trading sessions. Zero. And most people completely missed it. Here's what's actually happening. The same Wall Street institutions that ignored XRP for years are now buying it faster than any crypto ETF since Bitcoin. Standard Chartered just put an 8 price target on XRP for 2026. That's a 315% move from current prices. You have 3 choices right now. You can ignore this like most people will. You can panic buy because everyone's talking about it. Or you can understand what's actually driving this institutional flood and make an informed decision. I'm going to show you the numbers, the risks, and what's really happening behind the scenes. Because this isn't about hype. This is about the biggest shift in institutional crypto allocation we've seen since Bitcoin ETFs launched. Let me show you numbers that don't make sense until you understand what's driving them. XRP spot ETFs launched in November 2025. By early January 2026, they pulled in $1.37 billion. That makes XRP the second fastest crypto ETF to hit $1 billion right behind Bitcoin. But here's where it gets interesting. December 31st, 2025. Bitcoin ETFs saw $357 million in outflows. Ethereum ETFs lost $224 million. On that same day, XRP ETFs recorded $5.58 million in net inflows. XRP jumped 11% that session, while the rest of the market was bleeding. From November 13th through late December, XRP ETFs went 35 consecutive trading days without a single net outflow. Not one. Bitcoin and Ethereum ETFs had multiple outflow days during that same period. In fact, Bitcoin shed $1.09 billion total, and Ethereum lost $564 million, while XRP was absorbing capital every single day. By January 2026, that streak extended to 43 days of positive inflows before finally recording a $40.8 million outflow on January 7th. Even that barely registered against the total accumulated capital. Now here's what that actually means. When you see 35 to 43 days of zero outflows, you're not looking at retail momentum traders. You're looking at mandate-driven institutional buying. This is pension funds, asset managers, and institutional allocators who completed their due diligence, received approval, and are now systematically deploying capital regardless of short-term price action. These buyers don't panic sell on red days. They execute mandates. They have allocation targets. And when multiple large institutions start executing simultaneously, you get exactly what we saw, persistent demand that absorbed every bit of selling pressure for over a month straight. The current total sits around $1.5 to $2 billion in assets under management across 7 XRP ETFs. And here's the kicker. During the first week of January 2026 alone, when Bitcoin funds recorded 4 consecutive outflow days totaling $1.38 billion, and Ethereum bled $351 million over 3 days, XRP ETFs kept posting net gains. They moved opposite to the broader market. This divergence tells you something critical. XRP's buyer profile looks different than Bitcoin and Ethereum. These institutions aren't buying XRP as a hedge or for yield rotation. They're positioning around Ripple's cross-border payment infrastructure. They're buying into utility, not speculation. The ETF structure matters too. Many institutions couldn't touch crypto directly due to custody requirements, compliance friction, and regulatory uncertainty. ETFs solve all of that. They offer regulated exposure, professional custody, and operational simplicity. For an asset manager overseeing billions, an ETF is the only realistic way to gain crypto exposure without building entirely new infrastructure. XRP now has that access, and institutions are using it. For 4 years, XRP sat in regulatory limbo. The SEC filed a lawsuit against Ripple in December 2020, claiming XRP was an unregistered security. That lawsuit killed institutional interest. Major exchanges delisted XRP. Banks backed away. The token was radioactive for anyone with compliance requirements. In 2023, a U.S. district court issued a split ruling. Direct sales to institutional investors were illegal, but programmatic sales through exchanges to retail investors were not securities. The SEC appealed, Ripple counter-appealed. The case dragged into 2025. Then everything changed. Donald Trump won the 2024 presidential election. His administration took an explicitly pro-crypto stance. In early 2025, Trump signed an executive order creating a national digital asset stockpile. He nominated Paul Atkins, a known cryptocurrency advocate, as SEC chairman. The regulatory environment flipped overnight. In August 2025, the SEC and Ripple dropped their respective appeals. The case ended. The 2023 ruling stood as precedent. XRP programmatic sales are not securities. That legal clarity removed the single biggest headwind that had suppressed institutional adoption for years. Institutions that had avoided XRP for compliance reasons could now move. The legal risk was gone, the regulatory uncertainty was resolved, and they moved fast. But the regulatory tailwinds didn't stop there. In January 2026, the Senate began markup of the Clarity Act. This bill would provide a clear legal framework for banks to engage with digital assets. It reduces compliance risks and clarifies how traditional financial institutions can integrate crypto into liquidity management and treasury operations. XRP stands to benefit more than any other crypto from Clarity Act passage. Ripple's entire business model revolves around bank partnerships and cross-border payments. Clear rules for bank participation would accelerate adoption immediately. Compare that to Bitcoin and Ethereum. Bitcoin has no regulatory overhang because it's clearly not a security. Ethereum got informal clarity when the SEC dropped its investigation, but neither has the same institutional utility proposition that XRP offers. XRP is designed for institutional use. It settles transactions in 3 to 5 seconds. Transaction fees are a fraction of a cent. The network is built for high-volume, low-cost transfers between financial institutions. Bitcoin takes 10 minutes to settle. Ethereum is faster, but still can't match XRP's speed and cost structure for payments. Institutions care about speed, cost, and regulatory certainty. XRP now has all three. Japan added fuel to the fire with crypto tax reforms in 2025. They reduced taxes from 55% to 20%. The change triggered a 6% surge in XRP prices as retail and institutional participation increased in one of the world's largest crypto markets. Ripple is launching its RLUSD stablecoin in Japan during Q1 2026. That's a major market with newly favorable tax treatment and growing institutional interest. The timing couldn't be better. The Trump administration's broader crypto policy also matters. When the federal government explicitly treats digital assets as legitimate financial system components rather than speculative threats, institutional investors face diminished compliance risk. Legal departments stop blocking crypto allocations, boards approve mandates, capital starts flowing. That's exactly what happened in late 2025 and early 2026. Jeffrey Kendrick at Standard Chartered captured the shift perfectly. He's the head of digital asset research at a major global bank. His 8 price target for XRP by end of 2026 rests entirely on regulatory clarity, combining with ETF adoption to drive mainstream recognition. Wall Street analysts don't publish $8 targets on speculative meme coins. They publish those targets when they see structural demand building from institutional capital with long-term mandates. The regulatory environment that killed XRP from 2020 to 2024 has been replaced by the most favorable policy framework crypto has ever seen. And XRP, after years of being held back, is the primary beneficiary. Here's where the math gets interesting. And when I say interesting, I mean potentially explosive. XRP has a circulating supply of roughly 65.5 billion tokens. Sounds like a lot. But here's what's happening to that supply right now. Exchange-held XRP dropped 45% during 2025. It went from 3.95 billion tokens down to 2.6 billion. By January 2026, exchange balances hit a 7-year low of around 1.6 billion tokens. That's the lowest amount of XRP sitting on exchanges available for immediate trading since 2019. Now add the ETF absorption on top of that. Every $1 billion in ETF inflows locks up approximately 500 million XRP tokens. That's 0.76% of the total circulating supply. The ETFs have already pulled in 1.37 to 1.5 billion. That is roughly 685 million to 750 million XRP locked in regulated custody structures that are not coming back to exchanges. If December's $483 million monthly inflow rate sustains through 2026, XRP ETFs could accumulate over $5.8 billion by year end. At that pace, ETFs would remove approximately 2.9 billion XRP from circulation. That's 4.4% of total supply locked up in institutional products alone. Combine that with the exchange balance decline, and you're looking at a structural supply squeeze. Fewer tokens on exchanges means thinner order books. Thinner order books mean sharper price moves when demand shows up. Bitcoin's 2024 ETF experience provides the exact template. As billions flowed into Bitcoin ETFs, supply moved into custody. When demand returned, price rallied sharply because there was not enough supply on exchanges to absorb the buying pressure without pushing prices higher. XRP is following the same path, but the supply removal is happening faster relative to market cap. Now, here's the other piece. Ripple controls a significant portion of XRP through escrow accounts. Every month, 1 billion XRP unlocks from escrow. In January 2026, that unlock released 1 billion tokens. But Ripple relocked 700 million of those tokens immediately. This is a disciplined approach to liquidity management. Ripple isn't flooding the market. They're releasing supply gradually, using what they need for partnerships and operations, then relocking the rest. They keep selling pressure controlled while maintaining enough liquidity for ecosystem growth. But as ETFs continue absorbing supply and exchange balances stay low, even Ripple's disciplined releases won't be enough to satisfy institutional demand if capital keeps flowing at the current pace. Think about the supply-demand mechanics here. You have institutions executing multi-million-dollar buy mandates. They need deep liquidity. But liquidity is tightening every month. ETFs are locking up tokens, exchange balances are at 7-year lows, and retail holders who survived the SEC lawsuit aren't selling at current prices because they're waiting for higher targets. That creates a classic supply shock setup. Demand is increasing from institutional mandates. Supply available for immediate trading is decreasing from ETF absorption and low exchange balances. Price is the only variable that can balance that equation. Analysts tracking ETF flows say monthly inflows above $300 million indicate robust institutional commitment. December hit $483 million. January started with another $69.5 million in the first week alone. As long as inflows stay above that $300 million monthly threshold, the supply absorption continues and the pressure builds. Now here's the critical technical level that matters. XRP needs to break and hold above 228 with volume. That level has been resistance multiple times. A decisive break above $2.28 confirms buyer strength and opens the pathway to $2.75, then $3. On the downside, 185 is crucial support. As long as XRP holds above 1.85, the bullish structure remains intact. A sustained break below that level would invalidate the supply shock thesis and suggest distribution is overwhelming institutional demand. Current price is hovering around 190 to 214 depending on the session. It's consolidating in a tight range. Low volatility often precedes big moves. And with supply tightening, while institutional demand remains steady, the path of least resistance is higher once that $2.28 resistance finally breaks. The supply dynamics building right now are exactly what you want to see before a major repricing event. Institutions are removing supply from circulation. Retail isn't selling. And the float available for trading keeps shrinking, while demand from mandate-driven buyers keeps showing up every month. This is how structural supply shocks develop, slowly, then all at once. While everyone was watching price charts, Ripple was building the infrastructure that institutions actually care about. Ripple now connects over 300 financial institutions across 6 continents. We're not talking about startups or small regional banks. We're talking about Santander, SBI Remit, PNC Bank, and CIBC. These are major banks processing billions in transaction volume annually through RippleNet. Ripple CEO Brad Garlinghouse made a bold claim. He says XRP could capture 14% of the SWIFT system's transaction volume within 5 years. SWIFT handles over $150 trillion in annual transactions. 14% of that is $21 trillion moving through the XRP ledger every single year. Now, I'm not going to sit here and tell you that's guaranteed to happen. That's an aggressive target. But here's what matters. Ripple is actually signing the partnerships and building the infrastructure to make that attempt. They're not just talking about disrupting SWIFT, they're executing on it. In November 2025, Ripple closed a $500 million funding round. That round valued the company at $40 billion. The investors weren't retail crypto enthusiasts. They were Citadel Securities, Fortress Investment Group, Pantera Capital, Galaxy Digital, Brevin Howard, and Marshall Wace. These are some of the largest institutional investors and hedge funds in the world. You don't get a $40 billion valuation and investment from firms like Citadel unless your business model has serious traction. These investors did months of due diligence. They looked at the partnerships, the revenue, the growth trajectory, and they wrote checks for hundreds of mil. On the same day as that funding announcement, Ripple announced a partnership with MasterCard and Gemini. This partnership enables stablecoin payments for credit card transactions. That's a direct integration into existing financial rails that billions of people use every single day. Then there's RLUSD. Ripple launched its stablecoin Ripple USD in December 2024. By 2025, it was integrated into Ripple's payment ecosystem. The stablecoin addresses one of XRP's biggest criticisms, volatility. Banks don't want to move money using a volatile cryptocurrency. Even if XRP settles in 3 to 5 seconds, price fluctuation during that settlement window creates risk. RLUSD solves that. It's a dollar-pegged stablecoin that moves across the XRP ledger with the same speed and cost efficiency as XRP, but without the volatility. Ripple is launching RLUSD in Japan during Q1 2026. Japan just reduced crypto taxes from 55% to 20%. That tax reform made Japan one of the most attractive crypto markets in the world overnight, and Ripple is moving into that market with a regulated stablecoin product designed specifically for institutional use. Here's why that matters. RLUSD competes with Circle's USDC and Tether's USDT. Those are the two dominant stablecoins. But RLUSD has something they don't. It's built by a company with 300 plus bank partnerships already in place. Ripple can integrate RLUSD directly into existing RippleNet corridors without building new relationships from scratch. If RLUSD gains traction in Asian banking corridors, particularly Japan and Southeast Asia, it creates another use case for the XRP ledger. More activity on the ledger means more utility. More utility means more institutional interest. More institutional interest means more demand for XRP. Ripple also launched Ripple Custody. This is an institutional-grade custody solution for banks and fintechs. It enables secure storage, tokenization, trading, and staking. Banks that want to offer crypto services to clients need custody infrastructure. Ripple is providing that infrastructure specifically tailored to regulated financial institutions. During 2025, Ripple made multiple strategic acquisitions to expand its payment capabilities. These acquisitions focused on improving payment efficiencies and expanding financial services offerings. The theme was consistent: build the infrastructure that makes institutional adoption easier. All of these moves validate the investment thesis that institutions are buying into. ETF flows show the demand. But Ripple's partnerships and product launches show the supply side. They're building the utility that justifies the demand. Compare that to most crypto projects. Most projects have a token, a white paper, and promises about future utility. Ripple has signed contracts with hundreds of banks, a $40 billion valuation backed by major hedge funds, partnerships with MasterCard, a regulated stablecoin launching in major markets, and institutional custody infrastructure already operational. That's the difference between speculation and utility. XRP has real-world use cases being deployed right now by institutions that move trillions of dollars annually. Now, does that guarantee XRP goes to 8 or 10 or whatever price target you see on social media? No, but it does mean the institutional thesis has substance behind it. This isn't a meme coin pumping on Reddit hype. This is a company with actual revenue, actual partnerships, and actual products being used by regulated financial institutions. That's what institutions care about when they allocate capital, and that's why they're buying. Let us talk about where XRP could actually go in 2026. And I'm going to give you the bull case, the bear case, and the realistic middle ground. Because if you're making investment decisions based on someone's price prediction without understanding the assumptions behind it, you're gambling, not investing. Jeffrey Kendrick at Standard Chartered published the most aggressive institutional target. He says XRP hits 8 by the end of 2026. That's 315% upside from the 2 last level, or about 275% from current prices around $2.14. His forecast assumes 3 things happen. First, sustained ETF inflows continue at December's pace or higher. Second, regulatory clarity improves with Clarity Act passage. Third, Ripple's RLUSD stablecoin gains meaningful traction in banking corridors, particularly in Asia. If all 3 of those conditions materialize, Kendrick believes institutional demand combined with supply absorption pushes XRP to $8. At that price, XRP would have a market cap around $524 billion. For context, Bitcoin's market cap is currently around $1.7 trillion, and Ethereum sits around $420 billion. Is $8 realistic? It's possible. But it requires near-perfect execution on all fronts. Regulatory approval has to stay favorable. ETF inflows have to sustain at very high levels. RLUSD has to actually capture significant payment volume. And macroeconomic conditions have to cooperate with risk-on sentiment in crypto markets. That's a lot of things that need to go right. Now, let's look at the consensus analyst targets. Most analysts cluster around 3.00 to 3.50 for end of 2026. That's a still 40% to 65% upside from current levels, but it's far more conservative than Kendrick's $8 target. The 3.00 to 3.50 range assumes steady ETF inflows averaging $200 to $300 million monthly, continued exchange supply decline, no major regulatory setbacks, and moderate success with RLUSD adoption. It doesn't require everything to go perfectly. It just requires the current trends to continue without major disruptions. At $3, XRP would have a market cap around $196 billion. At $3.50, that's roughly $229 billion. Both numbers put XRP solidly in the top 3 or 4 cryptocurrencies by market cap. But they don't require it to flip Ethereum or approach Bitcoin. Then there's the 4.0 to $5 bull scenario that multiple analysts have outlined. This scenario assumes ETF inflows sustain above $300 million monthly exchange. Supply continues dropping, RLUSD gains real traction in Asian corridors, and we see 1 or 2 major catalyst events like BlackRock filing for an XRP ETF or a major US bank announcing XRP integration. At $4, XRP's market cap would be around $262 billion. At $5 worse, it's roughly $327 billion. These targets put XRP neck and neck with Ethereum's current valuation. For that to happen, institutions would need to view XRP as a legitimate infrastructure layer for global payments, not just a speculative crypto asset. The narrative would have to shift from XRP is a good trade to XRP is critical financial infrastructure. Now, let's talk about the technical levels that actually matter in the short term. XRP is currently trading in a range between $1.85 and $2.28. The $2.28 level has been resistance multiple times. Price has tested it, failed to break through, and pulled back. That level is packed with sell orders from traders who bought higher and want to exit at break-even or small profits. A decisive break above $2.28 with strong volume would be the first major bullish signal. It would force short covering, trigger stop losses on short positions, and pull price toward the next resistance zone at $2.75 to $3.00. On the downside, $1.85 to $1.87 has been solid support. Price has tested that level multiple times in recent weeks and bounced every time. As long as $1.85 holds, the bullish structure remains intact. Buyers keep showing up at that level to defend it. If $1.85 fails and XRP closes below it on strong volume, the next support zone is $1.77 to $1.80. That's where prior buyers historically defended and where fear sentiment tends to peak. A move down to that level would likely trigger panic selling from retail holders and test whether institutional ETF buyers step in to absorb the supply. Technical analysts also point to a death cross pattern forming on longer time frames. That's when the 50-day moving average crosses below the 200-day moving average. Traditionally, that's a bearish signal. But in crypto, those signals can lag actual price action by weeks or months. The concentrated liquidity between $2.50 and $3.20 creates another interesting dynamic. If price breaks above $2.28 and starts moving toward $2.50, there's a cluster of limit orders and options strikes in that zone. Breaking through that liquidity wall could trigger an acceleration towards 3.0 as short positions get squeezed and momentum buyers pile in. Now, here's the reality check. XRP is down 37% from its all-time high of 3.65 set in July 2025. It's been consolidating for months. Price action has been choppy. Even with all the positive ETF flows and institutional news, XRP hasn't broken out yet. That tells you something important. The market is still digesting supply. There are sellers at every level above $2 who bought during the rally and want out. Until those sellers are absorbed, price won't move sustainably higher, no matter how bullish the fundamentals look. ChatGPT's AI model, for comparison, recently predicted XRP hits around $2.02 by early December. That's barely above current levels. The AI focused on bearish technicals and macro risks, basically saying XRP stays range-bound unless something major changes. The gap between ChatGPT's $2.02 prediction and Standard Chartered's $8 target is 41%. That massive spread tells you everything about the current uncertainty in this market. So, what's realistic? If ETF inflows continue and no major negative catalysts hit, $3 to $4 by end of 2026 seems achievable. That's a 40% to 90% return. Not life-changing for most people, but solid compared to traditional markets. If everything goes right and we get multiple positive catalysts, $5 to $6 becomes possible. That's a 135% to 180% return. That would be an exceptional year. And if Kendrick's perfect storm scenario plays out, maybe we see $8, but I wouldn't bet the farm on it. Now let's talk about what could go wrong, because if you're only hearing the bull case, you're not getting the full picture. First, the stablecoin competition. Ripple's RLUSD is trying to compete with Circle's USDC and Tether's USDT. Those two stablecoins already dominate. USDC has over $40 billion in circulation. Tether has over $140 billion. RLUSD is starting from zero. If banks decide they'd rather use USDC or USDT because those stablecoins already have massive liquidity and established infrastructure, RLUSD never gains traction. And if RLUSD fails, one of XRP's major utility arguments disappears. Banks won't use volatile XRP for payments if they have stable alternatives that work just as well. Here's the bigger problem. It makes more sense to move money with stablecoins than with volatile cryptocurrencies. Even if XRP settles in 3 to 5 seconds, price can still move during that settlement window. Why would a bank take that risk when they can use a dollar-pegged stablecoin with the same speed and cost? Ripple's answer is RLUSD. But that means XRP's utility case depends on RLUSD's success, not XRP itself. If RLUSD captures payment volume, great for Ripple's business. But does that drive XRP demand? Maybe, maybe not. Second, Swift isn't sitting still. Swift knows blockchain technology threatens their business model. They're already testing their own blockchain solutions. They're partnering with major banks to upgrade their infrastructure. If Swift successfully integrates blockchain technology while maintaining their existing network effects and relationships, Ripple's entire thesis of capturing 14% of Swift volume falls apart. Swift has 11,000 financial institutions in over 200 countries. That's the most powerful network effect in global finance. Ripple has 300 partnerships. That's impressive growth, but it's not even close to Swift's scale. Disrupting an incumbent with that level of entrenchment is extraordinarily difficult. Third, macroeconomic risks. If the US enters a recession in 2026, or if the Federal Reserve starts tightening policy again because inflation rebounds, risk appetite across all crypto markets compresses. It doesn't matter how good XRP's fundamentals are. Crypto markets are highly correlated. When Bitcoin drops 30%, XRP typically drops 40% or 50%. XRP's high correlation to broader crypto markets means it gets hit harder during downturns. Even with steady ETF inflows, a sustained bear market or crypto winter could overwhelm positive catalysts. Institutional buyers might keep accumulating, but if retail panic sells and macro conditions deteriorate, price can stay depressed for months or years. Fourth, Ripple's monthly escrow releases. Every month, 1 billion XRP unlocks from escrow. Ripple has been disciplined about relocking most of it, but if market conditions change, or if Ripple needs capital for acquisitions or operations, they could release more supply than usual. Even the perception that Ripple might sell large amounts can suppress price. The escrow schedule is public. Everyone knows when unlocks happen. Traders position around those events. If selling pressure shows up right after an escrow unlock, it can trigger stop losses and create cascading liquidations that push price down quickly. Fifth, regulatory risk hasn't completely disappeared. Yes, the SEC case is over. Yes, the Trump administration is pro-crypto, but administrations change. Congress could pass restrictive legislation. International regulators in Europe or Asia could impose rules that limit XRP's utility in key markets. The Clarity Act looks likely to pass, but it's not law yet. If it gets watered down or fails to pass, some of the regulatory clarity that institutions are counting on evaporates. Banks might pull back from crypto partnerships if rules remain ambiguous. Sixth, competition from other Layer 1 blockchains. Solana, Avalanche, and newer chains are all competing for institutional adoption. They're faster than XRP in some cases. They have smart contract functionality that XRP lacks. If institutions decide they'd rather build on Ethereum or Solana because those ecosystems have more developer activity and more flexible functionality, XRP gets left behind. XRP recently added Ethereum-compatible sidechains to attract developers, but that's playing catch-up. Ethereum has thousands of developers and billions in DeFi liquidity. XRP is starting from much further behind in that race. Seventh, ETF flows can reverse just as fast as they appeared. The 35-day zero outflow streak ended on January 7th with a $40.8 million outflow. That was small, but if institutions start pulling capital because they've hit their allocation targets or because better opportunities appear elsewhere, ETF inflows could turn into sustained outflows. Remember, institutions allocated to XRP because regulatory clarity improved and ETFs made access easy. But if those same institutions decide Bitcoin or Ethereum offer better risk-adjusted returns, they can rotate out of XRP just as systematically as they rotated in. And here's the final reality. Despite $1.5 billion in ETF inflows, despite all the positive news about partnerships and regulatory clarity, XRP is still down 37% from its July 2025 all-time high. Price is range-bound between $1.85 and $2.28. It hasn't broken out. That price action tells you the market isn't convinced yet. Supply overhang from people who bought higher is still weighing on price. Until XRP decisively breaks through resistance and holds those levels, all the fundamental analysis in the world won't matter. I'm not saying XRP is a bad investment. I'm saying you need to understand the risks before you make any decision. Every analyst giving you an $8 price target should also be telling you about stablecoin competition, Swift's response, macro risks, and correlation to broader crypto markets. If those risks don't materialize and everything goes according to plan, great. But if even one or two of those risks become reality, XRP could trade sideways or down for the next year regardless of institutional adoption. This is not financial advice. I'm not a financial advisor. I'm just a guy on YouTube showing you information. You need to do your own research and make your own decisions based on your risk tolerance and investment goals. So what do you actually do with all this information? Let me break it down into actionable steps without telling you what to buy or sell. First, if you want to track whether the institutional thesis is playing out, watch the ETF flows. There are free dashboards that update every 60 seconds showing real-time assets under management for all 7 XRP spot ETFs. XRP Insights is one. These dashboards show you daily inflows and outflows, total AUM, and how many XRP tokens are locked in custody. The key number to watch is monthly inflows. As long as inflows stay above $300 million per month, institutional commitment remains robust. If inflows drop significantly below that level for multiple consecutive months, it signals mandate-driven buying has exhausted, and you need new catalysts for the thesis to continue. Second, watch the technical levels I mentioned. The $2.28 resistance is critical. A decisive break above that level with strong volume confirms buyer strength and opens the path to 2.75 and $3. Until XRP breaks and holds above 228, the range-bound price action likely continues. On the downside, 185 is your key support. As long as price holds above that level, the bullish structure stays intact. A sustained break below 185 invalidates the supply shock thesis and suggests distribution is overwhelming institutional demand. Third, track the Q1 2026 catalysts. 3 things could move the needle significantly. BlackRock filing for an XRP ETF would be massive because BlackRock's Bitcoin ETF became the largest in the world. If they enter the XRP market, it signals top-tier institutional validation. Ripple's RLUSD launch in Japan with actual bank order volume matters. Press releases about partnerships don't move markets. Real transaction volume does. If Japanese banks start moving billions through RLUSD corridors, that validates the utility thesis. And watch Trump administration crypto policy. Any executive orders, SEC guidance, or Clarity Act developments will impact institutional confidence. Favorable policy accelerates adoption. Restrictive policy kills momentum. Fourth, understand exchange supply dynamics. You can track XRP balances on major exchanges using blockchain explorers. As long as exchange balances continue declining while ETF holdings increase, the supply squeeze thesis remains valid. If exchange balances start climbing, it means holders are moving XRP back to exchanges to sell, which increases available supply and reduces squeeze potential. Fifth, monitor Ripple's partnership announcements and RLUSD adoption metrics. Ripple publishes quarterly reports and press releases about major partnerships. But focus on transaction volume and revenue, not just partnership counts. A partnership with a major bank means nothing if they're not actually using the technology at scale. Sixth, keep perspective on your portfolio allocation. Even if you're bullish on XRP, speculative crypto investments should be a small portion of your overall portfolio. The sample portfolio structure from earlier applies here. Your core holdings should be in less volatile assets. Crypto, including XRP, should be the small slice where you can afford to take risk. If you're putting 50% or 70% of your net worth into XRP because you're convinced it's going to $8, you're not investing. You're gambling. And even if you're right about the direction, the volatility along the way could force you to sell at the worst possible time. Seventh, understand that timing matters as much as thesis. The institutional thesis for XRP might be completely correct. ETF flows might continue. RLUSD might gain traction. Regulatory clarity might improve. But if all of that happens, while Bitcoin is in a bear market and macro conditions are deteriorating, XRP still trades down with everything else. You can be right about the fundamentals and still lose money because you bought at the wrong time in the cycle. That's why watching technical levels and broader market conditions matters just as much as understanding the fundamental story. And finally, remember that institutional adoption is a process, not an event. The $1.5 billion in ETF flows didn't make XRP jump to $8 overnight. It's created steady buying pressure that's slowly absorbing supply. If the thesis plays out, price moves higher over quarters and years, not days and weeks. Institutions don't create parabolic pumps. They create sustained trends. If you're expecting XRP to 3x in the next month because ETFs are buying, you're going to be disappointed. But if you're thinking about where XRP could be in 12 to 18 months if institutional flows continue, that's the right time frame. None of this is financial advice. I can't tell you whether to buy, sell, or hold anything. What I can tell you is how to track whether the institutional thesis is working, what levels matter technically, what catalysts to watch, and how to think about portfolio allocation and risk management. The rest is up to you.